hello, hello. Thanks everybody for the day so far and for being now with us here in the main hall. Uwe Hostmann, one of the general partners and actually one of the founding partners of Project A, will now give us some lecture about the ugly truth in venture capital. He has been around in this business for a long time now. I think it's been 12 years. Quite some journey already at Rocket Internet, now Project A. And I think he has a lot to share that usually VCs don't really like to talk about. Because who likes to talk about ugly stuff, right? But I think it's part of the spirit of this, this event to go for full honesty. So thanks a lot for what you will share with us, and applause to Uwe Hostmann.
Absolutely. Thanks very much, Rainer. Now the first thing, hopefully this is not going to be a lecture, because lectures probably for those of you who had the pleasure of going through some of them in recent times, it's not a very nice experience. So hopefully we can make this somewhat interactive. I can somehow see some of you here, so whenever you have questions, then please just shout. If you disagree with something, then just please shout, this is not true. If you just want to comment that this is boring or I should go faster, any kind of input is really appreciated. And what I want to do with you in the next couple of minutes, I have to check my watch from time to time because I want to make sure that you guys don't miss too much of your lunch break, is talk about the ugly truth about our own industry. So venture capital, the industry that I'm kind of representing, that Project A of course representing, is in an eternal, I don't want to say conflict, but an internal relationship with of course the startup world. And today we want to, as Rainer said, in the essence of real knowledge sharing, we want to open the kimono a little bit and tell you a little bit about the dirty secrets of our industry. But maybe, yeah, I think we can skip that. So my name is Uwe, as Rainer said. I think it's quite clear that we have reached peak startup hype. Probably the Germans among you know this show. It's called Die Höhle der Löwen. There is, of course, a famous example in the United States called Shark Tank. There is one in the UK. There is one in the Nordics. Actually, if you check the Wikipedia list on Höhle der Löwen or in Shark Tank, you see there's, I think, 60 or 70 different instances from all over the world. There is a Shark Tank, there is a Höhle der Löwen in Afghanistan, for example. And typically it's always a combination of some menacing animal and some kind of uncomfortable location. So Shark Tank, lion's cave, tiger pit or whatever. So it gives you a little bit about a feeling already about how the public perceives our industry. And of course, we as venture capitalists, we kind of do a little bit what the people in those shows do. So you sit there, you wait for startups to come in. They basically come in on their knees, begging for money, pitching you. They're showing you basically their baby, and you're kind of like, oh, this baby is pretty. Ooh, this baby is ugly. I don't want to put money into that. That's kind of what the public now thinks how the startup world really looks like. And I think all of you working in an entrepreneurial environment already know this is not exactly the reality. But for sure, we've seen that peak startup hype has been reached. And at least the topic of startup and entrepreneurship now is in everybody's minds. And that's of course a good thing, first of all, because also a lot of established corporations are really struggling with digital change, are really struggling with how they should transform their own businesses. So, you know, big retail organizations, big publishers, but actually all businesses. Software is eating the world, as Mark Andreessen said. So I think every established company has to wonder, what do they want to do with their business? And the answer seems to be just be more like a startup. Just stop wearing boring clothes and wear more fancy stuff. Just stop drinking coffee, start drinking mate. Just hang out in Berlin and move away from wherever your little company is located. And suddenly, miraculously, you're going to be innovative. And people come to us, to Project A and to other venture capitalists asking, so how do we do that? Because obviously we have to have the answer. We have to have, you and us, we have to have the answer, because venture capital is roughly 100 billion euros every year that's being invested, and money goes into the best companies in the world. So Facebook, Google, Amazon, all those companies wouldn't exist if it weren't for venture capital. And if you put 50,000 euros or maybe 100,000 euros very early on in Uber, you made more than 100 million, or more than 50 million, but insane amounts of money. So isn't this the best industry in the world? Venture capital, you only work with innovation, you make shit tons of money, isn't that great? Well, the first ugly truth about venture capital that I'm going to tell you is venture capital doesn't work. So that's my own industry, and sometimes I tell this also to people who are asking for us to answer, but the ugly first fundamental ugly truth about venture capital, about my industry, is that basically it doesn't function. Because what you would expect, of course, from venture capital, that they return a lot of money. You know, all those businesses, you invest, you rip parts of the company away from the founders by giving them a little money early on, and suddenly I own 20% of the business, I do nothing to help to grow it, and that should make me rich. But that's basically not how reality looks like, because the average return, if we think about venture capital as an investment product, people give Project A money to invest this into startups, so they expect obviously a return. And the average return of that whole industry is basically shitty. Yeah, it's more or less zero, depending on how you look at it, but the average return of that industry is really bad. So that is an ugly truth. Basically, all of those guys who are pretending to be, geniuses about business, who can evaluate your business ideas all the time, most of those guys actually don't make any money with what they actually should be doing. And why is that this way? If you look at how success is distributed in the startup industry, it basically looks somehow like this. I made a little chart here. It won't get more scientific than that, so bear with me for a moment. This is basically a chart that shows all startups. All startups, and we look at them by how successful they are. So the success rate is basically on this end of the diagram. There's only, in startup world, as we all know, there's only two outcomes. It can be a disaster or can it be a success. There hardly is any middle ground. At least, and I probably should add that, when we talk about technology innovation startups. All of what I'm saying is not true about starting a new bakery. All that I'm talking about are innovative business ideas. So all of us are probably working on stuff that is new, that is also, it's also radically new. It's not just improvement, a little bit of the status quo, but we're trying something new. So when real innovation happens, this is how success looks like. There's a very, very small set of companies that are very successful, and basically all companies, it's a bit of a pessimistic view, but basically all startups are not successful if you just look at the overall statistics of something like that. And this graph here, it should actually run around the room a couple of times. That's how the reality actually looks like. But now, coming back to the ugly truth about my industry, and I told you already, it's hard to be successful as a venture capitalist. We tend to build portfolios. Yesterday we announced a new fund. It's $200 million that we want to invest in startups like the ones you're working in or starting or running or you will start in the future. So we build portfolio of like 20 to 25 companies with every fund. And then we look at, of course, what's going to happen with those startups. If you look at the top 100 companies of the last decade in the United States, and the proxy that they take for success is the IPO volume. So how valuable were those companies when they actually finally made the step to the stock exchange? One investor, and keep in mind, we talk about hundreds of thousands of companies and thousands of investors. Now I'm taking the top 100, and one investor alone, a company called Sequoia Capital, was present in 36 of those 100 companies. That is insane. If you look at the overall market with the thousands of investors and the hundreds of thousands of startups, nobody seems to be making any money, but just a very, very small group of people actually is making money because somehow they find out how to beat the odds tremendously. And just to illustrate that, what does it mean for my industry? It's a quote by somebody who gives money to venture capital funds. And if you keep the graph that I just showed you in mind, that of course means you have to go for the outliers. You don't want to invest into an average startup. You only want to invest if you really think this startup is in the top 1% of startups that you're ever going to see. And underlining that is basically almost all venture capital funds like Project A, venture capital funds like us, if they're successful, and success means you return more than double, maybe ideally more than 3 times of the capital that you got from your investors back to them, if you want to be a successful fund like this, basically all of those funds had one investment, one single startup that's returned the entire fund. And that's what statistics tell us. So you don't build a successful fund by just having 25 mediocre companies and they all contribute a little bit. You build successful funds by having very, very few, very, very successful companies. What does that mean? And now I want to shift a little bit from just telling you how our ugly truth looks like to what does it mean for you? How can you use that information? So the first good news are, if you want to be a successful venture capital firm, you probably have to kind of change the way how you think about things. Because it's a bit of a joke that venture capital itself as an industry hasn't changed a single bit basically in 30, 40 years. It has been around for that long. It was started in the United States, of course. And basically since then, it's been old white men sitting in corner offices and doing basically what Höhle der Löwen pretends to be doing. They're sitting there, beautiful offices, nice art on the wall, and they just wait for startups to come in, and like a Roman imperator, they decide about life and death. Your baby is pretty, your baby is ugly, you get money, you don't get money. That's kind of the whole job description. At least it used to be for a long time. But those times are of course over, because there's enough money in the ecosystem. That is good news. There's enough people who want to invest into startups. So really, really good startups tend to have options. Really, really good startups are not the ones that need to be knocking on every door, but actually they have a choice. And the power balance is already turning a little, and it will continue to turn, and I think that's good news for all of you. Because of the ugly truth about venture capital, that only very, very few people are successful, people will need to become more innovative when it comes to thinking about venture capital. And venture capital, of course, only makes sense if it's a product for entrepreneurs. You have to think yourself as a VC more and more about what can I offer to people so I can convince them to take my money. It's a bit of an absurd situation, but we are basically in the business of selling our money to you guys. On a little detour, that's of course why we're doing also all of this. The Project A approach is of course to be helpful, to be actually operational helpful. It's not just about me telling you, oh, I think we should change the strategy a little like this and that and so on. There's a big debate where that actually is helpful. You probably, if you deal with me, you have to put up with that. You just have to accept. I think Mats from Dixa is here. I think he just has to accept that from time to time I'm going to give him some advice. And then he's probably smart enough to pretend that, oh yeah, that's some interesting points. I'll take that into consideration. But hopefully what's actually going to be helpful is working with the people who organize this conference and to hold the workshops. So that, I think, is pretty good news, that venture capital has to be a product for entrepreneurs. This is exactly the same slide again, as you have noticed. I just wanted to try out the Google Slides function that you can click where it automatically generates a slide for you. And I forgot to delete it. How does that work in practice? What actually happens now? This is a real statistic from the Project A, from the past 12 months at Project A. It kind of illustrates, I think, a little bit how our business actually works. So, in general, we speak to around, the numbers are actually a bit higher now, but I'm just going to use the number because the point is the same. We speak to roughly 1,000 startups every year. That's kind of like the throughput that we have. The 1,000 startups that we speak to are basically a selection, a survivorship of, by now, roughly 10,000 startups every year that we learn about. The database is being basically filled by 10,000 new startups every year. Then we decide to speak to 1,000 of them. Then the team speaks to 1,000. Then the partners, so Anton and myself, we speak to like 300. Then 40 or so, 30 to 40 every year, we will conduct actual due diligence. We will actually spend a lot of time trying to understand what is the business about, and then ideally making an investment. We invite them typically every Monday. So every Monday there's startups pitching at our offices, and then we basically end up with like 8 to 9 investments every year. But that shows you a little bit how your odds are. If you're pitching a venture capitalist, you're probably starting out as, you know, number 5,188 up there in the funnel, and you need to go through a lot of steps. They quickly, if you make it to the next step, you're already basically in a sample of very good startups, and then ideally you'll make it all the way through. But this is basically how the odds are kind of stacked against you. If I just want to briefly walk you through, keeping everything in mind that we learned so much about venture capital, about how we actually make decisions, it's actually pretty straightforward, right? So we obviously care very much about the team, about the product, about the business model, about timing. Not super surprising, probably. Yeah, all of those things you can probably pretty quickly understand and check in your box, right? So we want a team, a diverse team, ideally intellectual humbleness, a good impression in the pitch. Not really surprising. On the product, we always say we want a 10 times better USP, and of course we all know what does that even mean? What does it mean that you want to have a 10 times better product? It's a nice thing that venture capitalists say. I think what we try, first of all, of course, it's basically impossible to measure. And also, if it's really going to be 10 times, probably hard to say. But of course, we want to have something that is reasonably, significantly better than everything else in the market. Business models, venture capitalists like potential for recurring revenues and healthy unit economics. And timing is something that humans are really, really bad at. Basically, no human is really good at predicting how markets move. But of course, as venture capitalists, we want to understand that the timing is now perfect for this market. So every pitch that we receive basically goes like, now is the perfect time to start this business. And that, of course, should also be this way. We want large markets, fast-growing markets. Don't spend too much time on your market explanation. If you can reasonably say, fuck this, it's big enough, that's also pretty much okay. And we're not gonna, if it's an edge case and we need to talk a lot about markets, then I think it's going to be discussion, but ideally your market is just one slide that says, yeah, it's big enough. We look for startups typically that show momentum. And as a very simple rule of thumb, momentum for us looks like 3 times growth year over year, another 3 times growth over year, 2 times, 2 times. And basically that kind of exponentially looking curve is basically what we're looking for. A lot of good businesses are growing slower, and they're great businesses, but they just don't have that potential, or they just don't show that potential yet in their momentum to really become an outlier. Remember, we will always ask ourselves, is your business able to be a billion-euro company? Because if I don't have the chance, it's never going to help me return my fund. That's very egoistic of me. Maybe your business is perfect. Maybe it can be successful, and maybe it can be 200 million euro worth of a company, which if I ask my parents who are teachers, like, why should this company ever be worth that much? What are you guys talking about? It's a bunch of kids that sit there with computers. It looks kind of like how you played computer games when you were in high school. How is this supposed to be worth that much money? So all of those numbers are, of course, very arbitrary, but if it's only going to be 200, and that's an arrogant thing to say, but if it's only going to be 200 and not a billion, it's probably not a real venture capital case. And that is, of course, one of the weird things about VC, and that's why we need to see this momentum, 3 times growth, 3 times growth, 2 times growth, 2 times growth, to really see the potential for this business to take off. And we like defensibility. So your company should be defendable through data, through technology, through network effects, anything really, but it needs to be defendable so that not somebody else sweeps in and takes away your margin. That's how we make decisions. The fund returnability, that's like on the last side of those criteria, that is what I just talked about. Every investment that we do needs to have the possibility or needs to have the chance for me to return, let's say, at least 50, 60, 70% of the fund. So for Project A, that will mean I will somehow have to believe that basically there's a 100 million euro check for me somewhere if the company sells that I can cash. And that basically means, because at the end of the journey, I will probably, Project A will probably own like 6, 7, 8, 9, 10% of your business. It has to be a billion-euro company. We're not saying it has to be super clear that this business is definitely going to be a billion-euro company, but we need to be sure that if it is successful, then this can actually happen. So this is what we call high risk, high return. Of course, the chances for a single startup making it are low, but if it makes it, if the company is successful, if the company is achieving their plan. A couple of things on just very simplistic. What are good things to happen? What are bad things to happen? What do we get excited about? Learning speed. I'll get back to that in a second. Actually, I can tell you now. When you send us a business plan, the only thing that we know is that this business plan is a lie. The chances that this business ever going to materialize in the way you planned is absolutely zero. Everything else is more likely to happen than actually what you predict. You know, people spend a lot of time in Excel models and we work a little with them, but we all know they're basically lies. And that is of course the case because together we are then embarking into uncharted territory. We're going to try something that nobody has tried before, so how would we know what's going to happen? And when I talked about team, we can quickly, you know, come up with like a lot of great ideas. Okay, they should be smart, they should be ambitious, they should have a great character, and so on and so on and so on. That list we can together create in an instant on a whiteboard, no problem at all. But what actually, of course, is interesting, we want to invest in people who are ready, somewhat ready for the unprepared, for the situation that we didn't plan for. And that for us means learning speed. We are very interested in people who are fast learners because none of us has a clue what we're doing. We don't have a real clue when we invest in your company. We don't know better than you. Of course, we want to appear very thoughtful and convinced, but basically none of us has a clue where this is going to lead. And the only way to prepare yourself for embarking into that on that journey is by being a good learner. And a good learner, we can mostly tell by being a good listener. And I'm telling you one little secret now. Of course, we ask entrepreneurs, so, you know, are you interested in learning more? And everybody, of course, says, yeah, I love to learn. I'm a great learner. What's your greatest weakness? Oh, sometimes I work too hard. Okay, yeah. All those questions, you know, we know. But one good predictor for how fast or open people are to input is how they treat people who they think they don't have to treat well. So we ask also around a lot in the company, you know, how did those people behave when they came in? I think it's a good predictor how people treat other people, how respectful people are to other people that they don't need to necessarily be respectful to, is a good predictor for how open they are to new input and for learning speed. We like Net Promoter Scores. We're extremely obsessed about customer feedback. What's bad, of course, if the team is not really committed, if we think that this product can become a commodity, if there are issues with the cap table. We don't like companies where the people actually in charge don't own a large chunk of the company. That's important to us. Because it's such a long journey, we can hold an investment for up to 10, 12 years. And if some people lose motivation at some point along the line, that is very, very difficult for us. Good. So far, so good. Now let's get a bit more concrete, and I'll have you out to lunch in about, I think, 10 minutes. What are the actually ugly truths? So we learned already that the first ugly truth is that venture capital itself doesn't work. And basically all of the ugly truths are now results of that. First of all, VCs are slaves to their economics. We are not as independent as we would like to be. What I told you all earlier about how we need to return money to our investors, I think already explained that every investment that we do needs to be potentially large enough to return the whole fund. So I think that is important. If you pitch your business, it's not so interesting for us if you tell us, oh yeah, but if it doesn't work that well, we still have like a 50 million euro company. It's nice to have, I'm happy to take it, but I'm more interested in what is going to happen if it actually works. That needs to be large enough. I'm not so interested in what happens when it doesn't work. When it doesn't work, it doesn't work. That rarely makes a difference for us overall. That's what we call downside protection. We're not in the business of protecting our downside. We're in the business of really going for maximum returns. VCs, as a consequence of that, have a very simple thought process. I think you can also get those slides afterwards, but this is basically our standard way of thinking in the investment team. Those are the questions we ask ourselves. First of all, we start with the market. If the market is too small, we can dismiss it right away. Can the company continue to grow? Is the team capable of building the product, but especially also building out the team? Does it have a good acquisition and retention mechanism in place? And will I make a return? It sounds very simple, but I think it's a good checklist to go through your pitch and look at those questions. Those are the first questions we ask ourselves before we dive deeper. And I think it's good to have them in mind. One thing, and now we're getting a bit more into the actual details of the industry. We are, of course, super scared of adverse selection. Adverse selection basically means that somehow, out of the 10,000 startups that I could see every year, I get dealt a sample that is not the best. That is what adverse selection means. So, a couple of things to keep in mind. Cold outreach. So, companies emailing us, basically just saying, hey, we are a company like this. we are attaching a PDF, please let us know if that's interesting. We receive an immense amount of those every year, and I don't think we have ever invested in an email that was just being sent to us, because it's just a sign of adverse selection. The good founders will always be able to get an introduction to us. We have a big network. You always probably know one or two people who can help you at least to get like some kind of introduction. It doesn't need to be good. But we put on our website saying, don't send us an email. If you must, here's the email address. But better, why don't you try to get an introduction? Because it's a bit unfair, because we kind of outsource a lot of work to our network, but at the same time, you're probably not going to build a €1 billion company if you don't have the hustle to somehow figure out how to get a warm introduction to us. So that already is a good indicator, or the other way around. If you don't get that, it's a sign of adverse selection. I put there, be careful with startup events, conferences, and pitches. Now, of course, this conference is a huge exception, but there's a group of startups that spends a ton of time on conferences, that invests super early on in personal branding. You know, it has become a lifestyle business. Be careful around that, because we have a natural bias to think that companies who are very successful are just building and running the company. They don't have too much time hanging out at conferences. They don't have too much time covering their personal life on Instagram, visible for everyone. So be careful with that. Now, of course, we learned that there is also very strong advantages of personal brand building, but you should definitely be careful about that and also think about how does this feel to venture capitalists. That's what I meant with there's a right time and place for personal PR, choose wisely. And also, we look pretty quickly at your company and try to understand what other people are you associating yourself with. Are you part of an accelerator program? There are good ones that are a big plus. There are other ones that we probably think of as like, so, I'm not sure if that really helps the startup. If you can argue, of course, that this was super helpful for you, then we're very happy to look at that. But if you kind of just got sucked into this and you're not really sure, and yeah, maybe it was so great, we of course use that to try to have an opinion about your judgment. So also be careful which other investors you deal with, which other events and accelerators, for example, you work with. VCs are obsessed about social signals and FOMO, of course, is like one of the favorite venture capital terms. It means the fear of missing out. So I'm slowly probably dissecting our super professional industry a little bit, but of course, even though we're high-paid executives who manage a lot of money, we're just people like everyone else. And we are also unsure when we make those decisions, sometimes more, sometimes less. But I think we also have to, of course, to pretend that we know what we're doing all the time, right? Because we have investors, but also VCs are, of course, looking for signals outside to get some confirmation. And the social signal aspect is very important. So basically, we almost always talk to other investors about your company. Because we know who are other investors who look at this company. We have good relationships with all kinds of VCs. So it's not easy to pitch VCs against each other. People sometimes try to do that, saying, oh yeah, but this company is very interested, this VC fund is very interested in us. If you do that, chances are we will kind of ask them, or we will find out if they actually are. And of course, if they are, that's great, and maybe there's a good opportunity for us to team up. But if they're not, that directly basically is like a negative signal for us. If somebody tries to game us and they don't trust us that we can find out whether they're actually right, I don't think that's a good signal. Another thing is, don't start too high in negotiations when we actually deal together. And that is interesting because, of course, you need to have some kind of self-confidence, but I would always recommend to startups to consider that if you actually say, oh, I want 100 million valuation and I want to raise 20 million euro, and if you're unsure you can get it, it is complicated. If you're unsure if you actually will get competitive dynamics going, I would be careful with that, because it's much better to start relatively low and then the market presses you up and you go back saying, hey, thanks for the offer, but I have a better one, then you get a positive dynamic going. And that is very great, because then suddenly the FOMO kicks in. When there's a deal where we think, okay, everybody's looking at that deal, everybody's looking at that company, we probably need to pay higher. This is when people are actually adding like large amounts of valuation on top of companies. But if you have the opposite effect, if somebody comes to us and says, I want 20 million euro valuation, we say, oh, we think that's too high. And he comes back and said, okay, I'd be okay with 12, it's a very negative signal. And already you're a bit in a downward spiral. And people like us, we of course also incentivized, yes, to have big returns, but you also don't want to make massive mistakes. So if you feel that like a company has negative momentum, it's hard for us to invest. VCs can't influence a company once they invested. Matt knows that probably. I obviously try to be helpful, but basically we're not co-pilots. We're kids that get in the back, hopefully don't cry too much. The entrepreneur is driving, and from time to time we are asking, are we there yet? Or I need to pee, or can we stop at McDonald's? So not really sometimes not really a huge contribution to the person actually steering the company. What I mentioned earlier, the big plan that entrepreneurs pitch us at the beginning, business plans, we know they're not true, we know they're lies. So that's why we are so interested. At least we know that we can't influence the business. At least we know we can't manage 20, 25 portfolio companies. So I really want to invest in the people that are intellectual, humble, open to input, so that they'll be able to navigate through whatever storm is going to come. And lastly, VCs are running an internal organization. And I showed you earlier how this whole process looks like. By now it's 10,000 companies every year that go into this process somehow. We speak to 1/5 of those, so 2,000. And that of course is only possible because we have a team. We have 2 partners, we're 7 investment managers, and it's just so helpful for you to make their lives easier. Right? Spend some time to work on a pitch deck, not because the predictions need to be ultra precise, but go basically through what I showed you earlier, the thought process. Ask yourself, is this really answering that? A lot of people, and I think that's one of the things we really enjoy at the moment, are not only providing a slide deck, but also an FAQ document, frequently asked questions by investors. And often it's like 20 pages, A4 document that you can read through. This of course does 2 things. First of all, it helps you a lot to understand. And we like to do our homework. The team is incredibly hardworking, and they will prepare, and just the interactions that you will have with the team are much better. That's the one effect. The other effect is, if there is a document of frequently asked questions by investors, it signals to me, man, somebody asked those people a lot of questions, so other investors are probably also involved. Even if those questions was never asked to you, just fake it. Because it will probably trigger me thinking that there is a lot of other investors who ask questions, that's why they compiled this document. And one last part is, we are an organization. Don't underestimate the more junior members of the team. They are actually the ones running the show. So our investment managers, the whole investment team, a lot of them are here today. They are much more important than probably all know that they are in the process. So they are the ones presenting ideas. They are the ones working with our startups. They're the ones doing due diligence. So they're incredibly important. Maybe it varies a bit from fund to fund, but I can definitely speak for Project A that it is not a waste of time to be speaking to them, quite the opposite. Oftentimes this is where the real work is getting done, and we work so closely with them that whatever they analyze really ends up with us, and then we decide together. It's not just them presenting, we deciding, but it's a real collaborative issue on how to continue with that company. And that is very important. I did them one big disservice at some point because I was asked in an interview, when do you get excited about companies? And coming back to what I said earlier, the really good companies always have options. I told this journalist that we get really nervous, we get really excited when a company does not return our calls, when they really show us that they don't need our money. And I felt like this was a cool thing to say in this interview, but of course what it resulted in that for a bunch of weeks, nobody returned our calls. Because it basically turned into the standard strategy for people, and I did a big disservice to the company. So the team asked me, when they knew that I was standing here again today, to of course say that this is not true anymore. We like companies that we feel are basically at the very top, but they don't behave that way. So they're very open, they return our calls quickly, they are on time, and all that stuff like that. We think that's actually a very good sign. The team really wanted me to make that point very, very clear. And those are, this is coming from the team, I guess I can't see, but those are the 6 ugly truths. One large ugly truth, the VC industry as itself is not working well, so we also have to innovate ourselves. 6 little ugly truths. I think you can have those slides, as I said earlier. Maybe it's helpful for some of you. Maybe it helped a little to understand how this industry works. how you can also game it a little bit, and that's pretty much it. Thanks so much for listening. Yeah. And just one last goodie. This is what I call Enrico's Ask Yourself checklist. Enrico is one of our investment managers. The only picture of him that I could find is this one. This is Enrico. I guess we should invest into better pictures. But and this is also, I think, something that is important. He just added one quick checklist that I think is super helpful. Do I even need venture capital? How should I think about it? So it's more of an internal checklist. Do I really need external funding? How much do I really need? How much ownership am I going to give away? How much am I worth as a company, as a resulting factor of that? Which investors do I need to approach? And how can investors be of help? Those are questions that you should ask yourselves and try to do your research. And it's just as important as all the preparation for the actual pitch is. And it's also just very good to have those kind of information thought through in your head, because we will ask you this also in a pitch. So I just want to share this gem of you, Enrico's, if that checklist has been helpful. And that's it, finally. Thanks very much.
Thanks. Thanks a lot, Uwe. You will be around for the rest of the day,
I will be
right?
around a bit, yeah.
Because you wouldn't miss a good party that we will have here in the evening.
Obviously.
And it's just not worth it to go home in between. Now it's lunchtime. We now have a break of approximately 1.5 hours. The talks and the workshops continue at 2:15. Lunch is served here in the back of the room, and please enjoy that. Stick around for the afternoon. I think some of the best talks that we have are actually happening in the afternoon, and you don't want to miss the party. Enjoy that.